Hey, today we are going to discuss about life insurance premiums. Life insurance premiums. So they can be like a whole life insurance or term life insurance. So when it comes to employee paying premiums with respect to whole life or term life, they are like not taxable, not allowed as deduction, but and even in the case of like the benefits that he received, that is also like not taxable. So when employee is paying premiums with respect to the whole life or term life, they are not taxable, not deductible, and even not the benefits are not taxable. So why don't we allow deduction? Means IRS says that, hey buddy, like you are paying rent, utilities, groceries, all these expenses for yourself, personal expenses, like the same wise the life insurance premiums that you are paying is treated as personal expenses, and we don't allow any deduction to you. This is what IRS says. And when it comes to employer paying premiums, okay, that can be with respect to the whole life insurance or term life insurance, the premiums are always taxable. The premiums are always taxable, and the benefits are not taxable. So the benefits that you get, with respect to this life insurance, that is not taxable. So simply I can say one thing: regardless of whatever that is, at every time the benefits that receive life insurance benefits that received by the employee are always not taxable. But in case when the employer pays the premiums, then the premiums are taxable in the employee's 1040. That is like in W2 that will be taxable. But there is an exception to this. When the employer pays premiums with respect to group term life insurance, so what does this mean? Group term life insurance means like he's taking group term life insurance for all the employees, like up to 50k coverage. The premiums are not taxable to the employee. And if the coverage is like more than 50k, the excess premiums paid on the coverage are taxable to the employee. Let me just take an example so that you can get a better understanding. Suppose the employer is providing, group term life insurance up to like 70k he's providing to employee. For the first 50k coverage he's paying 5k premium, and the next 20k coverage he's paying like 2k. So up to 50k, the 5k premium that he's paying is not taxable to employee. The excess beyond the 50k, the 2k, is taxable to the employee on his 1040. So when it comes to employer paying premiums with respect to group term life insurance up to 50,000 coverage, the premiums are not taxable. Beyond that, the excess is only taxable to employee. This is what the exception. Term life insurance means, suppose the person takes life insurance for a term, that means like for 10 years or 20 years or 30 years he takes life insurance for a term. Then if he dies during that period, he get the death benefits, not the the beneficiary get the death benefits, which are not taxable. And there is no surrender value here. There is no surrender value because there is no surrender value and he cannot get the dollars. So what does this mean? If he takes a life insurance policy for 100k, he keeps on paying the premiums. He can't surrender the this policy and get money. That is the situation. Usually in this, the premiums are very low. Apart from the like death coverage, you won't get any benefits in this term life insurance. But when it comes to whole life insurance, this is valid for full your lifespan. Okay, you pay every year for the premiums. When you die, you get this death benefits 100k, like that. Apart from this, like whatever the portion that you are investing, let me just say that 10k is the annual premium. 10k, 10k, 10k. For the 5 years you just contributed 50k premiums, and a portion of this is invested in a like a stocks, mutual funds, like bonds or something like that. And you will be getting a portion of your income, like which is growing over a period of time, that is like cash value. That is usually for the beginning years, that is less than the premiums that you contributed. Let me say the first 5 years you contributed 50k, the cash value can be like 20k to 30k. Usually what happens here is every year he will be contributing some premiums, and a portion of that is invested, and his cash value will be growing, which is usually less for the initial years. Like let me just say for 30k, if he surrenders this policy he gets 30k which he can use. So this is the benefit in the case of whole life insurance. Whereas in the case of term life insurance, like only the death benefits is only the benefit that he's getting. Like here the investments will be growing over a period of time, that is the only thing. And when it comes to whole life insurance, the premiums will be usually higher because he's getting a lot of benefits, that's why the premiums will be higher. When it comes to term life, the premiums will be lower, like you get it. And one more thing, like taking the same example here, like if he contributed 50k, the sum assured is like 100k. Like at the end of the fifth year he got to know that there is some organ failure, like he's going to die within the 2 years. That means in the case of terminally ill patients or chronically ill patients, we have this option, like they have this option like to surrender the policy and get money. Suppose if he surrenders the policy, he gets like 30k. Okay, he paid the premiums 50k, but he if he surrenders he gets the 30k. So keeping the same example here, he contributed every year 10k, that is like 50k he contributed towards the premium, but the cash value is like 30k. In that case, if there any some, if he wants to surrender the policy, that usually happens when he wants some money, or in the case of terminally ill patients or chronically ill patients, that means like if went to a doctor and doctor said like there is organ failure, like he can't live for, he will be dying within the 24 months, and he's in need of funds. So in that case he can surrender the policy and get some money. If he surrenders the policy, he will get only 30k. Then the concept of viatical company comes into picture. So viatical company, so what does it do? It makes money by purchasing your policy, and later point of time it sells the policy and makes money. So how does this work? You paid 50k premiums and the cash value is like 30k. So the a vertical comes into company comes into picture. It says that, hey buddy, I'll be purchasing your policy, I'll be paying you 50k. If you go to the insurance company, it will pay you only 30k, but I'll pay you 50k, just give me the policy. So you will give the policy to the vertical company and get and take 50k from it, and the vertical company pays the balance premium. Suppose if you are going to die within the next 2 years, the next 2 years premiums 20k vertical company will be paying. Okay, 20k will be paying, vertical company will be paying 20k, and that just paid you 50k. But when it sells the policy, when you on the death, like it makes 100k. So it makes 100k and it paid you 50k, and it paid the 2 years premiums, your premiums 20k, 50k. So that is like 30k is profit to the vertical company. So why are we discussing all this? Means the insurance profit that the death benefits that vertical company is getting, it will pay tax on that. Whereas you are getting 50k from the vertical company at the time of selling your policy, that is tax free to you. There is no need to pay any taxes on that. This is the whole concept of vertical company. So that's it.